Jamila, let us do this question. I'll start with the inventory. The name of the company is Save Riders. They sell cycling helmets to local sports stores, and it uses first in, first out method of stock valuation, as well as the periodic inventory system. And the owner or the business is owned by Tsebo. Then we have information below that appeared in the records of Save Riders for the year ended 30 September 2024. It says the business uses a fixed selling price of 2,425. And they give us information here about stock or helmets on hand on the 1st of October 2023. Please note that the 1st of October 2023 will be the beginning of the year because the end of the year is the 30th of September. And then they made a couple of purchases in November, May, and August. However, they returned helmets in, well, they returned helmets from May. They didn't tell us when they were returned. But these helmets, because they're from May, we're going to use May cost price to find their cost price. So our cost price here will be 1,350 for these helmets. Let's check how much that gives us. That will give us 8,100. Okay. And they gave us the number of helmets that we sold, as well as helmets. We need to find helmets on hand on the 30th of September. They didn't give us any value or the number of units. But that will normally be determined by the stock method we are using. And here we are using first in, first out. The first question requires us to calculate the number of helmets. And according to this, to calculate the number of helmets, we're going to use a simple formula, guys. And the formula is balance at the beginning of the year. You only focus on the units, which was 80. Then you're going to add your purchases, which amounted to 520. And then you subtract the returns, and there were only 6 returns. This will give you units available for sale. Now let's calculate 80 plus 520 minus 6. It gives you 594. Then you're going to take units available for sale of 594 and compare them to units sold. And that was 440. Just to explain this, we have 594 units or helmets on our disposal that we are willing to sell. However, out of these units that we have available, we only sold 440. Now, the difference between what we have available to be sold and what we actually sold will be units on hand. How do we get this? You will take units available to be sold minus units that were actually sold. And let's see how much that will give us. It'll give us 154 units. So at the end of the year, we only had 154 units available. Now to calculate the value of those units at the end of the year, it depends on the stock valuation method. And according to the stock valuation method, it's first in, first out. So we're going to use that. To use first in, first out, I prefer to draw a timeline. So we know that our financial year will start on the 1st of October 23. After October, you're going to have March, April, May, June, July, August, and September. So this will be the 30th of September 2024, and we calculated that we're going to have 154 units. 80 units started the year. We purchased 230 units in May, actually in November. And then we purchased 170 in May. And then we purchased 120 in August. Now, guys, to understand what first in, first out method means, it means what came in first was the first one to be sold. So if we were to look at that, it means the units we had at the beginning of the year and the ones that we bought earlier in the years were the ones that were sold. But we are left with only 554 units. Do you think the units that we had in October, which is the beginning of the year, do you think we will still have them by the end of the year? There's no chance, because those are the first ones that were sold. According to this system, it's first in, first out. So there's a high chance of the last purchase units being part of that 154. But before I can do that, you go back to the question, you realize that there were 6 units that were returned. And these 6 units that were returned come from May. So I'm just going to go to May. Okay, that was big, dramatic. I'm just going to go to May. And from May, I'm going to subtract my 6 units. I'll be left with 164 units. So these units here I no longer have these ones here. So that's the balance I'm going to have. However, please note of that 154, 120 will come from the last purchase. So 120 will come from here. And the cost of these 120 units was 1,200. And then the remainder, when you take 154, you minus 120, you'll be left with 34. This 34 will come from the second last purchase. And the cost of second last purchase is 1,350. When you add these amounts up, they will give you the number of units that we given to you, which is that 154. To get the value, just multiply those and you will get the value. Multiply these two and then add them up. So it's 1,200 multiplied by 120 plus 1,350 multiplied by 34. That'll give you 189,900. This here will be our cost of stock on hand. Okay, so that will be the value of the stock on hand. So this is the method that I normally use. I find it to be very, very easy. For 1.3.1, they want us to calculate cost of sales. So to calculate cost of sales here, because they said we are using the periodic inventory system, the formula for calculating cost of sales is balance at the beginning of the year which was 72,000. You focus on the rank values. You will add the purchases, which amounted to 615,000. And then you minus the returns, which amounted to 8,100. And then you will normally add things like your coverage on purchases, custom duties or import duties, and then you minus the returns. Now, to get the value of cost of sales here, because I don't have space, I'm just going to use this and say 615, you minus your 8,100. That will give us 606,900. And then you minus closing stock. So as I said, it's normally balanced at the beginning of the year plus purchases minus returns plus coverage on purchases plus custom duties, and then you minus the value of your closing stock, which is 189,900. Then you will get your cost of sales. 72,000 plus 606,900 minus 189,900. This will give us 489,000 as our cost of sales. To calculate gross profit, you'll normally take sales, which was 440 units that were sold at 2,425. It'll give you 1,067,000. You just minus cost of sales that you calculated above of 489,000. And this will give you your gross profit. Of 578,000. That's it. Now, the owner's death is not sure why the accountant told him it will be better for him to change from first in, first out method of stock valuation. Still wants to continue using first in, first out method, but the accountant wants to use the weighted average method because he says the profit will be lower, which means that they will pay less tax. They have approached you as the internal auditor to advise them on which method they should use. You need to substantiate your answer by providing 2 points. Well, for me, I think they still need to continue using first in, first out method. What I like about this method is that your closing stock is valued at the most recent prices. So you won't have to impair your stock. To impair your stock means you won't have to devalue it because now the new products are on the market. I'll give you one example, guys. When iPhone 17 comes out, what do you think will happen to the price of iPhone 16? Exactly. So you want to be, now imagine you're not even left with iPhone 16, you're left with iPhone 15. So it's better for you to be left with iPhone 16 than to be left with iPhone 15. So that's why I prefer first in, first out. You are left with the most recent models, and you're also, those models are valued at the most recent prices. So when you have to devalue your stock, if there is a need, you don't have to devalue them by a huge amount. Got it. Secondly, gap principle. The gap principle of consistency will not be met as it requires elements to be recognized at consistent valuation methods for comparability purposes. So imagine, guys, your stock last year was first in, first out. This year is weighted average. How do you compare the two? You can't, because you use totally different methods. So now comparability, which is part of gap principles, will not be met because you won't be able, guys, you need to compare apples with apples. You can't compare apples with bananas. Okay? And there are more reasons, guys. And here, guys, we are selling helmets, to be honest. And even though I chose first in, first out method, you could have also could have chosen the weighted average method because they don't expire at all. So the method must actually be chosen not because it reduces your profits or it increases your profits. That should not be the reason. You must choose a method that will be appropriate for the type of product that you're selling. I hope that is clear. For 1.4.2, we need to use calculations to prove that the weighted average method will decrease profits. So when you use the weighted average method, and I need to highlight this, so the final amount we need to round it off to the nearest rand. Under weighted average method, guys, before you can calculate cost of sales here, you need the value of your closing stock. And to calculate the value of your closing stock, you first need the weighted average price per unit, of which you will get by taking the value of your opening balance, you add the value of your purchases, you minus the value of your returns, you add coverage on purchases, you add custom duties, which are import taxes as well. And then you divide this by the units. Units of opening stock plus units of your purchases minus units of your returns. Then you can add units gifted. So these are normally, if you are a good customer to a supplier, they'll give us some goods for free. And sometimes those goods will return them, so you can also subtract gifts. Please remember, denominator is units, numerator is values. Values are normally in rand value. According to this, rand value of opening was 72,000. Rand value of opening was 80. I mean, the units were 80. Rand value of purchases was 615,000. And the units were 520. Then rand value of your returns was 8,100. We actually minus returns. And the value of your returns was 6. This will give us weighted average cost that we can actually use to calculate the value of our closing stock. So this will give us 1,142,000,93. To calculate the value of closing stock, you will take number of units of closing stock, which is 154, multiplied with 1,142,93. How much does this give us? It'll give us 176,011. To calculate your gross profit, you will still take sales, which amounted to 1,067,000. Then you minus cost of sales. You will get this by taking your opening was 72,000. You add your purchases minus returns. So let's see, 615,000 minus 8,100. It'll give us 606,900. Then you minus that 176,011. That will give us cost of sales. So our cost of sales will be 502,889. And then you will get your gross profit, which will give us 564,111. And this side of a profit was 178. So we can safely say we have proved that the profits have decreased.